Oh, we're good. We're live. We're live. Hi, everyone. Welcome. Hope you can see us. If you can, feel free to say hi. We can see your comments, and so you're welcome to comment below the video the entire time. I'm Kristen, the GM of Hatch. I'm joined by my co-founder, Natalie Ferguson, who is our head of customer experience. This is our third, is it our third Wine and Wealth, Nat?
Yeah, it might be our third.
Yeah.
We've had a few additional things as well.
Yeah, lots of cool stuff. So what we like to do is we like to chat. We like to chat quite excitedly about all sorts of stuff, about money and investing, which can actually be quite interesting. We try not to make this a boring money talk. And so to help us along, we've got some wine, hence the Wine and Wealth. Nat, what are you drinking tonight?
I've got a Merlot, my classic. What have you got?
Sav, my classic. Oh, yeah. Oh, you're doing red with it.
Every time. Sometimes I've had water.
I love it. So welcome. Again, feel free to say hey in the comments, everyone. So nice to have, spend your next hour with us. I hope you've got a drink. I hope, this lockdown, semi-lockdown is going okay for you. You and your families are safe. It's been a very tough year and for the markets as well. So we'll chat a little bit about that. But Hatch is Kiwi Wealth's digital investing platform. We are now 2 years old. We've started with the US share markets because it is one of the most exciting share markets in the world. Happy to go into that, but we've got lots of plans. We're looking at other markets this year. We're looking at funds and KiwiSaver as well. So lots of great stuff being part of the Kiwi Wealth family. We've got a fantastic team of 22 in Wellington. Always a friendly face. If you want to reach out and chat with any of the crew, we can be reached on Facebook at hello@hatchinvest.nz, but hopefully we can get to some of your questions tonight. I want to, so I've introed us, that's good. Oh, now I can see your hellos. Yay, good. Hey, everyone. Nice to see you. I can't see you, but I just want to chat about legal stuff. Tonight, Nat and I will talk a little bit about probably some companies and some funds. We might talk about investing strategies, and it's all really just to augment education. It's not personal advice. So you've got your own unique scenarios, depending on how long you want to invest for, how old you are, your risk tolerance, all sorts of stuff. So please don't take this as financial advice. When we drop things, it's really just a prompt to look into something. And really just to kind of, pique your interest in a particular area or maybe a popular fund or a common strategy. And when we talk about also our own personal stories, again, that's it's not right. It's just what we do. And that's the great thing about investing is there's no right and wrong. It's just super cool to be doing it. So that legal stuff sorted. And with respect to risk, what's that?
Jim from Levin.
With respect to risk, we talk really positively about investing because we've had really positive investing experiences. The markets have been on fire for the last decade, which, we're quite young. So we haven't, I've been through the GFC, but I probably wasn't a significant investor at that time. We had a crash earlier this year. We've since recovered. So our investing history has been positive. Those that have seen some real downturns, you'll have some different experiences. So all to say that there are risks with investing. Your money in the markets can go up and it can go down. So please be conscious of that. It's really important you make, the right decisions for you and for the time that you've got to have your money in the market. So tonight, we're going to talk about 5 areas. We've got a lot of things to cover. So we're going to try and get through a ton of it, all in 1 hour, in under an hour now. And we talk quite quickly. So please feel free to comment. Oh gosh, questions already. Hey, Jim from Levin, nice to see you. But yeah, we've got lots of questions already. But hey, we will get to them throughout. I'll kind of pepper them throughout. But the 5 areas we want to touch on tonight are why and how to approach investing. Why invest? How are we going to approach it? The second is I'm going to quiz Natalie, see if she's got some quick answers for me on some jargon. The third is investing behaviors and pitfalls. These are the things you want to watch out for. How to build a portfolio. That's a really common one. A lot of people just get stuck with, I don't know what to do. So we'll just talk about some really common approaches to building a portfolio, which companies and which funds. And the 5th thing is, when should I invest? Markets are scary. How do we time it? When do we invest? Is really, a common question on everyone's minds. And then again, as I said, we'll do questions throughout. Go ahead and ask them. Now, let's start with the very first, which is why and approach. I just want to have the most simplest answer to the why, and then I'm going to hand it over to Nat with kind of approach and how do we prepare to invest. And the why is that investing in the share markets historically has been one of the best ways to grow money, to grow your money and to build wealth over the long term. So it's a fantastic place to grow money, far better than a savings account. You can easily buy and sell, so it's an investment, not like a house that's really hard to get out of if you need your money out. It can take a long time. Investing is really liquid. We're going to go into jargon. And then finally, you can make money off investing two ways. One is your share value can go up. So a lot like buying a house and capital gains, your shares can increase in value. And so you can sell at a future date when they're worth more. And the second thing is dividends, which is we're going to cover that in jargon as well. And that's actually, I'm not going to give Nat the answer to that. So now I'm going to hand it over to Nat. And how do we get ready for investing? Well, I'm going to check out some questions.
Cool. Hi, everyone. I think also, Kristen, I'm going to ask you a few questions during this as well. So like Kristen says, one of the great, all those great things that come from investing in shares, one of the things that we hear a lot, though, we actually probably hear two different kind of sides to investing in the share markets, and it comes from all sorts of different things. But one of them is this kind of idea, and I know, Kristen, you don't like this word, but this idea that investing in shares is gambling. And I've been kind of thinking about it a bit recently, and so that was kind of our approach with this, that we've both been kind of just thinking what makes investing good. And what makes a good investing approach, and what we've kind of boiled it down to is being mindful when you're investing. And that's kind of a thing that, you know, across the board we are becoming more and more aware of in life. So it's kind of about being deliberate and thoughtful rather than kind of doing, we're going to go into some pitfalls later, but just kind of rolling on in without having a plan or an idea of what you're doing. And what that leads to, this kind of mindset or this idea that investing is gambling or it's really kind of a hit and miss sort of thing, is one of two things. Either people jump in and treat it like a casino, or that they don't, because they just think it's not for them because it's too sort of just taking a stab in the dark. So to start with, when we come to talking about mindful investing, the first thing we wanted to talk about is what's your focus? Like, why are you investing? And like Kristen says, there's all these great things that come out of the share markets, but why are you investing? And one of the things that I like to talk about is, and I think that they've done it brilliantly, is Lotto. They paint a picture for you of a lifestyle that you might want to lead. It's not about diving into piles of money, which investing tends to have that reputation of this idea of this greedy person sort of swimming in, was it Scrooge McDuck? Whereas Lotto is sort of that dream of your life. So I think that's like a really good place to start when you're looking at investing, is what do you want to achieve from it? So this is my first question for you, Kristen. What is your goal when it comes to investing?
My goal's super boring. I hate to say it, but I am a long-term investor. So anything short-term, I just keep in cash. If we've got a trip in the next year planned, which, you know, go local this year, that I kind of keep it in cash. And within my investing, actually, it's long-term. So I've got kids' education, and then I've got kind of a Kiwi saver and funds as well. And then I've got some company stocks that I'll talk about later. And I'm on the fence. Those are either going to go to my kids later in life when I retire, or if I don't have enough money, they're mine.
Well, I also have heard recently that you have a goal of, what is it, moving to Raglan and surfing?
Oh yeah, that too. No, I want to do that next
year, right? Like we do this for that.
Yeah. Okay. Sorry. I realized we're talking about like the dream. Yeah. Well, the retirement is the dream, right?
Yeah, it's the dream retirement, or the time you want to retire, or all of that sort of stuff is actually really, I think we have a lot more control over that than we think. The number of people I speak to who just assume at 65 is retirement age. And I, as most sort of reasonably long-term Hatch customers will know, I'm a huge fan of the FIRE movement, which is like basically you take control of when you want to retire and how you want to retire. So yeah, very not so much the surfing and Raglan, but yeah, definitely for me, it's very much about choosing the jobs that I want to do, being able to take time off when I want, traveling the world, all that sort of stuff. That's the why. And I think it's really important to know that, because otherwise you're kind of all sorts of stuff happens, like Kristen says, and things go up and down. And if you really kind of know what you're working towards, as with anything in life, it's kind of it kind of gives you that way of kind of staying focused. The second part of it is each investment, sort of knowing the why for each investment, why. And that kind of comes down to a really simple thing. Like Kristen said, there's two ways you make money from investing. So firstly, when you're actually deciding to invest in something, I always think it's really helpful to think, why am I doing it? So for example, do I think it's going to grow in value? Do I think that the shares I buy today will go up in value? Or do I think that the shares that I buy today will pay me dividends? I'll get some income from them. Or the third option, which is something we talk about a lot in this context, is this something I'm investing in education? Like, those are really the three reasons why you would ever buy a particular company or a fund shares. And there's all sorts of stuff you can look at in that when you're thinking mindful investing. So like, for example, if you think a company will grow in value or a fund, you're basically saying, I'll use Tesla as an example because we talk about it so much at the moment. Or maybe, like, let's say Disney instead. If I was to buy shares in Disney today, what is my goal? Let's say I think Disney Plus is going to take off. I think COVID's going to roll over and all the theme parks are going to do well. Then I need to decide, like, when would I sell them? What's my goal for them? Am I going to wait until, if I buy them for $100, am I going to wait till they grow in value to $200 and I'm going to hold on to them regardless until they do that? Am I going to hold on to them until I've made a small profit and I sell out the amount of money that I invested initially, so I get all my money back and just leave a little bit in that's no longer, I have no skin in the game, and leave it to do that? I think it's a really good idea to look at what you're planning on doing and why you're buying those shares. Again, if you're thinking that you actually just want to get income from your shares, you're not actually worried about the share price rising, will you hold on to them for a set amount of time? Like Kristen, when you talk about long-term investing, do you plan to sort of have those paying you out money over time? Like, it's that sort of questions that I think it's really useful to ask yourself.
And so now I've kind of got a good sense of, like, anything in life that you want to achieve, you've got to kind of set goals and take steps towards it. So how am I going to prepare? When am I actually ready? How do I know I'm ready to start investing?
Interesting. I think this. Well, I mean, I feel like it's a pretty common thing, but I'm not actually sure if it's as common as we know now that we work in the industry. But firstly, I think all this stuff sounds a lot more complicated. We think it's a lot more complicated than it is. Firstly, let's talk debt. If you have any debt, and I break debt into two buckets. One is that kind of mortgage, maybe even student loans, that it's not bad debt. It's debt that you're using to build a life for yourself. That's kind of debatable. And we actually have a lot of people who have mortgages and who have student loans who are happy to start investing. I would say definitely if you have credit card debt and anything that means that you might be in a position that you might need money in a hurry, or that you're paying out high interest, I think you should seriously consider, or I would seriously consider not starting. When it comes to a mortgage or student loans and that sort of stuff, it's really, we have a whole bunch of different opinions on that. A lot of different investors take different approaches. Some people are more comfortable waiting. I heard about a woman the other day who had, I think, $5,000 in student loan, interest-free. Financially, she was told the best thing to do is just to leave that. She's not paying any interest on it. But mentally, for her mental health, she couldn't move forward knowing she had that debt. So she decided instead to pay it off and start with a blank slate before doing anything else. So that's one thing to get out of the way before you even start looking at kind of growing money. Then it's really simple, and I think the Barefoot Investor is a kind of a big advocate of this. Kind of start with three buckets. First bucket, and we talk about this a lot, emergency fund. You should have, and they often talk about 3 to 6 months income, or not income, expenses set aside. So if you lose your job or things turn to custard, you have that safety blanket. That amount is actually a really sort of contentious amount, because one of the things that 3 months does is, for a lot of people, that's quite a lot of money. And so actually ramping up to that amount is so off-putting that they never kind of get there. So what I've seen recently around the place is a lot of people even talk about having, $500, $1,000. Start with that emergency fund. So if things happen, like your car breaks down or some unexpected expense comes up, you've got that money there. But once you've got that, then you actually just keep contributing to it as you're doing other stuff. The flip side of that emergency fund, and we have it actually, I think I saw today a few sort of 60-plus-year-olds on here, they're actually, depending on sort of timeframes and that sort of stuff, you may want to consider having a bigger emergency fund. You just want to, that is your mental sanity fund, I suppose. That's the thing that stops you having to panic and do things in a hurry. Once you got that out of the way, then you're now down to 2 buckets, your short-term savings and your long-term savings. And it's in most analysis you see online and from most people who write books and talk about this stuff, it's a very clear line: 5 years plus and 5 years and less. And anything that you're going to do in the next 5 years, if you're going to go on a holiday, if you're saving for a house, anything like that, that's your short-term savings. That's money you want to store and know exactly how much it's worth at any time, and you're happy to sacrifice growing that money for having it there as you're sort of ready to go. Anything more than 5 years away, that's the money you're actually able to grow. So like, again, the 3 buckets: get your emergency fund, get your short-term savings, get your long-term savings. The great thing about them is then you just keep contributing to each bucket.
Awesome. Nat, we're going to go into, we've got 1 minute.
Oh,
I'm going to call out some jargon, and you're going to give me quick 5-second answers. But quickly, just Janet's asked about the FIRE movement. And Janet, we're going to get, Nat will talk about you the next hour, so I'm not going to let her do that. So Christine's going to post in the comments the FIRE blogs that are on Hatch, and you can actually follow their journey. So hooray. Right, Nat, stock.
That is when a company wants to raise money. They it's basically another word for company or share. They release a stock, basically, which is made up of which is basically shares, which is a small slice of a company. And I like to use the word shares more because you basically think of it as you own a share of the company, or you're a shareholder of the company.
IPO.
That's called an initial public offering, and that is when a company does want to raise money. For example, they want to grow. One of the ways that they have available is to take that privately held shares. Every company has a bunch of shares, and instead of just being able to choose who buys them, they list them on a share market and allow anyone to buy them.
Risk.
Risk is a very misunderstood word. A lot of people think.
Oh my gosh, you have 5 seconds.
Okay, great, losing everything. But it's actually generally, when it comes to the share markets, money going up and down over time, the volatility.
Nice one. Bear market.
Bear fights downwards. So that means when the bear claws down, that means the market is going down. So your money is going down in value. Bulls fight up. So when the bulls are happening, then they're going up. Your money's going up.
Ticker.
That's a unique code that every company has when it's listed on a share market, so you can identify it as a unique identifier.
Name one.
Apple is APPL.
AAPL, but close.
AAPL.
Yep. We talked a little bit about dividends. You already got that one. Good one. Let's end on diversification.
The putting your eggs in heaps of different baskets to lower the chance, or lower reliance on any one of them doing super well or not doing super well.
No, I lied. Dollar cost averaging.
Gosh, this is like a quiz. It's like I feel like I'm back. I think I'm back in school. I'm speed dating. Thanks, James. Dollar cost averaging is the concept of investing the same amount over a period of time in the same set time frames. So you aren't trying to time your investments. You're just trying to smooth out the ups and downs. It's also a very successful way to invest.
Jason said I'm wrong. I'm not wrong. It's AAP. Yeah, there we go. Anyway, good. I like being right too. Hey, if anyone else knows of any jargon that you want us to talk about, just list it below. Any questions?
Kristen next time. Give her a go. Kristen, I need to know, like, now we've gotten through that, my rapid fire. So obviously there's a whole bunch of ways that you can invest. And I think a lot of people think that they're limited to one way. I'm just interested to know from you, what are some interesting investing behaviors that we've seen or that you think are useful for these guys to find out about?
Yeah, good. Investing, I think we put too much focus on how to do right, and actually the right thing. It's so hard to get, be the perfect investor. There's kind of no such thing. And I think there's a lot of just great sayings about patience beats smarts on any day in the market. And so it's like you've got those people, professional stockbrokers and financial people that you think, not know a lot more than us. They probably spend a lot more time researching and make more educated decisions with investing potentially, but no one can control what's going on. And so it's, I suppose, with respect to, I guess my point there is there's a couple things. Patience was what my point was. And so patience beats smarts any day. Long-term view, most of your investing should be boring, like your Kiwi saver. You're just going and setting and forgetting, and it's just growing quietly in the background. And so obviously checking in on it, making sure it's at the right levels. But patience beats smarts. Pretty hard to beat the market, to time the market, to be really clever, to get rich quick. So it's really just about plugging away year after year, putting what you can away into investing. But we'll also talk about some exciting stuff too, which is company investing, because that's a little sexier. So patience, number one. Second, be aware of the world around you. Again, it's like investing. A lot of people think it's not for me. Well, it's just, you're investing in businesses. Warren Buffett tells us, think of it, would you buy the business? If you would buy the business because you think it's fundamentally a good business, then you're probably a pretty handy shareholder, or at least consider being a shareholder in that business. We'll talk a little bit about how you might look at a business and its health to do that. But being aware is kind of looking at trends and thinking about the products that you use every day, from the Apples we talked about to Microsoft's, Facebook, what's happening there. I probably would have said, if I didn't see my daughter on Instagram and thousands of teens on Instagram these days, I'd be like, Facebook is over, because, we're not as engaged on Facebook as we used to be, my generation. But look, Facebook owns Instagram. And so think about Netflix and the behaviors that we've seen change, particularly over the last couple of years, move away from TV to Netflix. This is all just really being aware of these growing trends and these businesses that are changing the way we do things, the Ubers and the Airbnbs, which is to go public this year, by the way, and just be aware that these are all businesses that you can invest in and benefit from their success, or into funds, and we'll talk about that too. So the second thing was be aware. First thing, patience. The third thing is do some research. Look, it's really important that you start to get comfortable with this world. You'll overcome a lot of fears. You'll overcome that feeling of I'm not good enough, I don't know enough. Just dive in. We'll give some cool resources at the end as well. My favorites are probably started with things like Ellevest and the Balance. Those are really fantastic kind of starting points. I saw someone else said Barefoot Investor. They love that. Now I love Bloomberg. I love CNBC. I love Market Watch. These are all fantastic resources. Even 10 minutes a day of CNBC can kind of get you over those fears, and you start to connect the dots of, that's just a company CEO talking about his business and his plans for growth. That's interesting. And so I guess those are kind of my behaviors, probably some good ones. And I think we should probably chat about some pitfalls as well, Nat. I think it's important that, again, we're focusing on this do good and be right and be the best. That's pretty hard. Just stick to the basics, and probably spend more time avoiding the bad behaviors and the pitfalls, which Nat's going to talk to.
Yeah, because I think one of the myths we were talking about earlier today was this idea that there's only one right way to invest, and actually there's a ton of them, and we'll talk about that a little bit more. But there are definitely some bad ways to do it, and I think, who was it? Jason just said Tesla is straight up gambling at the moment, and I think that's just such an interesting point, because I would say one of the biggest pitfalls is FOMO. I would say nothing is gambling unless you don't know what you're doing. And by that I mean, if you were to invest in Tesla today because you saw the hype around it, you knew 5 people who had invested in it, yes, absolutely, that would be gambling, and that's a terrible idea. If you had conversely done a whole bunch of research about Tesla, you'd formed an informed opinion that you think it will still go up in value. You have like I say, you'd thought through the reason why you wanted to invest in it, and you thought you backed that in 20 years time that share price will be higher, then that's actually quite different. It's not necessarily about the investment itself, it's about the behavior you have doing it. So I would say some recent examples that you may or may not have seen in the news, Air New Zealand, for example, that rocketed up while the airline industry was grounded. And what happened is, as it went up, it kept going. Robinhood, which is an international platform, had a very similar thing, and what they'd done is at the top of their platform they showed the most popular, the biggest gainers the shares that had gone up the most, or the most popular, and more people then invested in them, and they'd created this up cycle of FOMO that led to people just investing blindly. And that's why we really like to talk about this mindful investing. Is that is a pitfall, and it's so easy to do, and everyone's done it who I know who's invested. And that's kind of one of the great things about starting small, is some of these behaviors you just can't avoid. Everyone's, you can hear the theory as much as you like, but everyone sort of has to make the mistakes for themselves. But I would say ideally you'd avoid that mistake. The other big one that I talk about a lot, and we always focus on some of the sort of the what happens if I make the wrong decision and all that sort of stuff. Not starting is a big pitfall, and we try and do these webinars a lot. And actually, like with the Getting Started course and all of this stuff, the point of these tends to be start in whatever way, shape, or form you need to. And we have so much information now about starting. One thing we find, especially with people, and we call them risk aware, not risk adverse, because actually there are risks. Like Kristen said, there are risks when it comes to investing. The problem is when you take those risks so far and you get so worried about losing any money ever that you never start. And what you've done is, by trying to conserve your money, you've given up on this huge opportunity to potentially grow it. So I would say it's another huge pitfall. And there's all sort of techniques to just get started. And I think, you don't have to start with a lot of money. You just have to kind of get in the habits. Again, with that lotto example, I love this example. A lot of lotto winners end up bankrupt, and it's because they didn't have the financial skills to deal with that money. So learn those financial skills, get comfortable investing with small amounts, and just start. The third pitfall is thinking there's only one right way. And like Kristen said, there's a bunch of behaviors. One of the things that was a light bulb moment for me after investing for a long time, and it sort of ties into that FOMO thing, of a particular company might get a lot of attention, and everyone's jumping on it, and you have this idea that there's some great companies and there's some bad companies, and everyone kind of has to invest in the same stuff. And actually that's completely wrong. Like I would say Kristen and I have completely different portfolios, as would everyone in Hatch, as does my little sister, as does everyone I know. And there is actually, the great thing about investing is there's actually a ton of great options, and that means you actually don't have to invest the same way as anyone else to be successful at it. And I think that that knowing that helps deal with the FOMO. The last one is relying on sort of a very narrow, limited of opinions. It's very easy, as with most things in life, to get caught in an echo chamber. We do it with politics. We do it with any sort of beliefs that we have. One of the great things I find about Hatch investors, if you're on our investors club, is there's a range of opinions on there. And again, they're all opinions. There's all sorts of great ways to find out all sorts of information to make an informed decision that's not just relying on a small amount of information. So yeah, I think that to me is the top four: not starting, investing out of FOMO, thinking there's only one right way, and relying on analytics. And I think at this point it might be useful, Kristen, to sort of pitch in with, if we're talking about getting a lot of different opinions, what's how can you use your community to make smarter choices?
Yes, we'll talk about cool community, because we know we've got Hatch Investors Club on Facebook. If you're with Hatch, you get that, which is super cool. Nat, just one quick point on your not getting started. Had you invested 10,000 in Vanguard's technology fund, so we know tech has had a pretty great run. It's changed our lives in the last decade, really, and the world and how we interact with one another. But had you invested 10,000 bucks, just thrown it in there and forgotten about it 5 years ago, that 10,000 bucks would be 30,000. So I think that really is about, what can you put away now and just kind of forget and just let it grow. If technology is an industry that you back. So yeah, that's VGT. I know that one, if you wanted to check those stats. And Christine, I think, will put up, actually, she's going to put up Yahoo Finance. And you can just, when you hear little ticker symbols from us, which we've already demystified, you can just type those in to suss that out. So the tech one from Vanguard is called VGT. But with respect...
Can I interrupt just really quickly on that front of that gone up with the tech fund? And that is actually kind of an interesting thing. A lot of people here at the really start of their journey, and you're talking about a couple of $100, maybe $1,000. I have been investing for a long time, and I know a bunch of people who have. And what you actually find, like you say, Kristen, that compounding, it's sort of, we talked about that with COVID when it first started. Humans are very bad at understanding the concept of exponential growth. We just can't imagine it. Our brains don't do it. So we all sort of underplay it. But that sort of level of growth, when you, on average, the share markets are growing by 10% a year, that compounding amount is just crazy after 10, 20 years. And it just starts by starting small, and it's sort of the reverse of a mortgage, where you initially start by just paying off, a few cents each payment, and by the end you're paying off chunks. It is a really, really beautiful thing when it comes to your finances, and it's well worth looking up and just really trying to get your head around. But anyway, back to the community. How do you find your community?
Yeah, community. So, hey everyone, we're going to try this thing with this Wine and Wealth, and this is a trial. It's going to be a 1-month trial, but Christine is going to throw up an invite to basically drop your email, totally private. We'll, destroy it. It goes into a Google form, and we're going to invite you to a private Slack channel. So if you're looking for like-minded community, it's only for those open on this call that are at the, not feeling super confident in their investing journey. There's lots of great places for ultra confident investors. So we'll just keep this to those that want to ask the questions. It's a safe place to do that. It's the Hatch Investing Slack Club. You will get an invite once you drop us our email. We'll probably send that out in the coming days. We'll start the group off with some questions, and then it's kind of really over to you. We're going to give it over to you for a community, a safe place. You can come in anonymously, use a different name, whatever. It's a private channel. So again, only those tonight that hear about it and give us our email will be invited to it. You can leave it at any time, and probably in a month we'll shut it down, but it's something that we want to have for a little test. So Christine's going to put up the link, and we would just invite you to give it a go. Just come in and try and see if you want to talk and ask questions, because there'll be a lot that, we may not answer for you tonight. I want to
just quickly, the goal with that as well is that everyone's come here tonight to either start or kind of ramp up. So you've already made that commitment. We recognize though that one webinar is not necessarily enough. So use that month to sort of ask the questions in a really safe space, and really challenge yourself to sort of figure out how you can get to that next step over the course of the month, and use that community and use us, because that should be the goal, is to sort of get off the sidelines and get started.
Awesome. Good. Well, we're halfway through, and we're on number 4, which means that the 4th and the 5th topics are kind of big, chunky ones. So we want to give enough time to them. The 4th topic we want to talk about is building a portfolio. So I'm going to kick that off with, again, not advice, but just kind of general thinking. Have a think about, there's a investing strategy called core satellite. Oh my God, like the worst, financial.
What do you call it, Kristen? What's your term for it?
Oh, well, mine is the core and then the sexy islands. So it's like the boring stuff in the middle, and then like the good sexy stuff. So let's talk about the boring stuff. If you look up, if you Google core satellite, the worst articles will come out. It'll put you to sleep. But it's kind of that concept of 80% of your investing money. So let's just say outside of your KiwiSaver, and then obviously emergency fund and money that you need, in the short term, you want to kind of just put 80% of it, let's say 60 to 80% of it, and just set and forget. Like that means that you're just plunking it in. It's probably going to be, it's going to be a fund, and they're usually really well diversified funds, meaning they've got lots and lots of companies in them. We're going to talk about which ones in a minute. But the idea is that you've got 2 or 3, keep it super, super simple, 2 or 3 really broad funds that basically cover the share markets around the world. So it's like, just think of it as you're invested in the share markets. Great. Probably, again, a lot like your KiwiSaver, which would be a really well diversified, probably mostly in shares, and it's really for the long term. So think of like a good chunk of your money, part of your paycheck, going into that core, boring, but sensible. Now think about the 20%, the sexy islands, and that's where you can start to. And when Nat says everyone's portfolio is different, that's when you're like, what's my secret edge, and what are the stuff I really know about, and how can I start to kind of look to outperform maybe that set and forget. Nat said that the markets on average grew 10% year on year. We'll talk about that in a quick sec in number 5. But that you may kind of be backing companies or really unique funds in hoping that they gain on average more than that 10%. Now, you don't have to. Your whole strategy can just be funds. In fact, Warren Buffett is like, just put your entire investment into the S&P 500. That's the 500 biggest companies in America. The most popular Vanguard fund of that is the VOO, Vanguard S&P 500. So you're basically investing in the biggest 500 companies in the States. And he would just say, put your money in that. So that's like one. That's huge. But that might not be the best strategy either. But he certainly backs America and those big companies. But again, keep it super simple. Now, again, back to the sexy islands. Think about, now everyone's going to call it that now, which is terrible. Think about, again, the stuff that you really care about, that you know about. It doesn't have to be companies. It can be funds, but it can just be something like, you know about healthcare. So you might look at healthcare funds. Pfizer would be kind of an example that, you know, when COVID started, I was like, oh, it'd be really interesting to kind of look at a healthcare company. Predominantly, I've been in technology that I've looked at because I feel like I know tech quite well. And some, mostly tech, to be fair. There might be the odd kind of sports thing in there as well, and gaming because I watch my children, you know, that kind of thing. But I think with the healthcare one, I was like, oh, what would be a company? And so I really looked into, you know, some of the top healthcare companies, Pfizer being one of them. I did a little bit of research. So those are, again, I'm not going to put all my money in it. That's just maybe one of my 20%. And I've kept it to my stocks. Really, I've kept it to under 15. If you have funds, it might be even less than that. So it's not, you know, big dramatic thing. It shouldn't be overly complicated. But that's kind of that core satellite approach. In terms of how much and how often, be good to hear from you what you do, Nat, in terms of that. But for me, again, my paycheck, a percentage of that, let's say if I want to do 15% of my whole paycheck into investing, or 20% if I'm feeling like I can afford that, then it might be like, the 80% of that money goes into kind of my funds, and then that rest of that money will just go into, I do more lump sums. So if I've kind of come into $1,000 or feel like I've built up $1,000 or something like that, I might just pop that into one company, like a Pfizer, like I've talked about. But I just want to say that with that core satellite, how would you start? You just have to start with one, like just take one step in one direction, and you don't have to get this perfect kind of core like portfolio together. You may actually just want to start with one company and start with kind of the satellites, or you might just start with one fund. It could be the really broad-based fund, or it could be the fund that, again, is kind of more the specialized, unique one. But I think the whole point is it's like when you're first getting started, treat it as education money. You may want to start with $100, it's a dinner out, and again, either pick one fund or one company, and we can chat about a couple options further down, and just put your money in it and watch what happens. Watch what's making it go up and down. You know, it could be obviously COVID and what's happening with the share markets. It could be the company itself is going really well, thanks again to what's happening around the world, or that kind of thing. So view it as education, just get started somewhere. So let's talk a little bit about the first place you could start, Nat, and that's funds. Maybe kind of talk about a little bit about what is an ETF, which I didn't test you on before because I thought you would do that here. Talk about some of the popular ones and being like those really broad ones, and then maybe some specialized ones.
Cool. I just wanted to quickly acknowledge Jason. I completely agree. No one will ever have a diverse portfolio that has no losses. The point is to be ahead on the majority. And Keegan, respectfully, I feel like I might disagree with you there. Warren Buffett meant investing in the S&P 500 if you're risk averse and can't handle investing in individual stocks. That may well have been the thing, but so let's start with talking about what an ETF is, and then I'll go into why I kind of disagree with that. So an ETF, this is the great thing about the finance industry. They make everything sound so much more complicated than it needs to be. An ETF is an exchange traded fund. It is a fund, just like your KiwiSaver. When you have your money funneled into KiwiSaver each week or month, it basically is put into a basket of investments. And different funds have different makeups. So there's some that have, they might invest across the entire world. Like there are some funds out there that will invest in every company, basically listed on every share market around the world. Others might have bonds in them. Some even have property, like the fund actually invests in property companies. So there's a whole bunch of stuff that just sits in this sort of pre-packaged shopping basket. And when you go to invest in one, you can actually see everything that's in it. And these days it's very easy to see sort of all the investments in a fund. So rather than having to pick an individual company and say, I back that Apple will be doing great in the future, or I think Lululemon is going to rise in value, I can go to a professional fund manager, and these are all available through Hatch. We have about 900 of them, and I'll talk about why that's not scary soon. And a professional fund manager's pre-packaged the shopping basket. You can see what's in it. You can get a vibe, like Kristen said. You're interested in tech. There's some funds that are invest purely in tech companies. You might be interested in cannabis. There's some funds that literally only invest in companies related to cannabis, electric vehicles, across the whole world. You even can get an entire portfolio in one fund. So the ETF part of it, when we talk about exchange traded funds, is for some reason the finance industry has decided the thing that distinguishes funds is the mechanism for investing in them. So for example, a managed fund, you go to a fund manager and give them your money. An exchange traded fund, you buy and sell shares through the share market. The actual underlying funds, the idea is always a basket of shares, but I don't know why they make it sound complicated. The reason, Keegan, I disagree is that I think what is truly risk adverse is leaving that 5+ year savings in savings, where it's sitting there basically staying the same in value or going down. Anyone who has invested in an S&P 500 fund over the last year over the last 100 years, should have experienced 10% money growth every year. Well, not every year, sorry, on average. And that to me, yes, maybe that to you feels very risk adverse. To me, that seems like a pretty good outcome for someone who just doesn't want to be actively involved every day in picking and choosing. And I think the reason why I wanted to make a point about that is I think there is a perception out there that you have to really be actively involved in building your portfolio. And I completely agree with Kristen that it is so good to set aside that 10, 20, 30% and play with it and learn and that sort of thing. But not everyone wants to do that. And I don't think it is a cop-out to just put 100% of your money in one of these funds or in 2 or 3 of these funds and actually let the markets kind of do their work for you over time.
And I'd say, I would definitely say that probably the popular ones, the Warren Buffett one is the VOO, that's the Vanguard S&P 500. And then there's also a bigger one that invests in about 3,000 companies. So again, the S&P 500 is 500 companies, but the VTI invests in just over 3,000. So you get some small companies in there as well. That's a really broad-based one. And then there's the VXUS, which is the really popular one that is basically the global share markets outside of the US. So if you kind of want to cover the whole globe, that is another option to look at. So you can do either VXUS or look at ETFs like that, just to consider some really broad-based ones.
And the only thing I would finish with that, we've just spent a lot of time, when I spend a lot of time talking about don't invest out of FOMO, fear of missing out. Sorry, someone didn't know what that meant. But one thing with ETFs, like I say, we have 900 available. Kristen's just listed off a couple of biggies. One of the few exceptions to FOMO in a way is when it comes to exchange traded funds. And by that, I mean one of the easiest ways to narrow down that 900 odd is to do some Google searches. So one of the easiest ones to do is to search for the biggest ETFs in the world, and you get a pretty good idea of the ones that are the most money in the biggest portfolio managers. And you can start to take a list of 2 or 3 of them, do a bit of, I think 2 of the top 3 are exactly the same, but run by different fund managers. So you can start to do a bit of Googling. If you are interested, and one of the cool things, like Kristen said, with that sexy island approach is there is a perception, again, that you should be picking individual companies for that 20%. But because we have these 900 funds, if you're interested in anything from social media to millennials to female leaders to, like I said, cannabis to e-commerce to any niche interest and robotics, basically any interest or theme or industry or economy. You could be interested in emerging economies. You could be interested in anything. The best and easiest place to start is by Googling the biggest ETF and whatever thing you're interested in. And it's such an easy starting point to just go and sort of do a little bit more digging to find. And a lot of people, I mean, I talk to a lot of people who invest through Hatch, and a lot of people just have 1 to 3 that they pick. They don't overcomplicate it. They don't try and invest in 20, 30 things. They just pick 1 or 3 and just sort of start funneling their money in. So I think funds are definitely.
I suppose the only other exception to that, the 1 or 3 making it the big things. But if people don't feel comfortable backing a single company, like e-commerce was a great example. I may not want to invest in Shopify, hey Nat, but like I might find an e-commerce ETF, which exists.
Yep.
And so it's like I'm just that little spreading my money out of lots of e-commerce companies. So just in case.
Well, yeah, and I think that's the benefit of that, right? So like, for example, cannabis is an emerging industry. There are multiple cannabis companies available through Hatch. Do you know which one's going to win? I don't. But what I might do is invest in a fund that covers all of them. Yes, if I'd backed the winner and I'd invested directly in the one that ended up taking off, great. I wouldn't back myself to pick that. So what I've done is sort of limit the amount that I could potentially make, but I am reducing the amount that I could potentially lose, which to me, in some situations when we're talking about that core, is such a great idea.
Totally. But let's talk about individual companies, because that's actually pretty exciting. Someone asked about taxes. I will get to that. And easy. So let's just quickly chat about how we pick companies. So rather than tell everyone how they should do it, I think we're just going to talk about how Nat and I do it very quickly. Nat, we only have 5 minutes on this one. So my 2 minutes basically is I am research based, so I like doing a lot of Googling and a lot of reading about stuff. I don't mind. I'm a little bit more comfortable. Like I said, I've started with I might have started with Investopedia and The Balance, and that gave me a pretty good overview of common investing ways of analyzing a company. But I've kind of moved on to, like I said, kind of CNBC, Market Watch, Motley Fool, Seeking Alpha. Those are all like kind of cool. So what I like to do is research a lot of stocks across those, not a lot. Again, let's take Pfizer as an example, or even Facebook. What I might do is go to Facebook's Investor Center, and they've made it really easy nowadays. So if I were to go Google Facebook Investor Center, and I'm thinking about investing in them, I'd have a think about look around me. Like I said, my kids are always on Instagram. I might do a little. Obviously regulation is a concern, so that could be a risk that might limit their growth in the future, depending on the government in the U.S. and how they might break up some of these big companies. Something to consider. But also, do I back Facebook and what they're doing? Maybe not, but I'm just using it as an example. Their business model is obviously advertising, lots of eyeballs, which means they need to be growing lots of eyeballs. And so I see, I go onto their Investor Center, and you can basically just watch a presentation. They've got Google Slides or PowerPoint presentation, and you can see the revenue over the past 5 years. You can see you can see user growth. You can see how much money they make per user. And so it really just gives you a sense of the growth trajectory of this company. And while, kind of looking backwards isn't always a good idea of looking forward, that's kind of where I start. The health of the company. Do they have, are they profitable? Are they making money? What kind of plans do they have in the future? So to look to that, I might look at the CEO, Zuckerberg's. I might read his annual report. I might attend the annual general meeting, which is him talking about the future of Facebook and the plans, acquisitions he's doing and how he's managing to stay on top. I might look at their competitors and how comfortable I feel with them continuing to grow, and any competitors that might take market share from them in the future. I think earnings reports really good. I might just Google the latest Facebook earnings and kind of see how they're going and how they're tracking. Earnings reports are 4 times a year, and they're basically the company report card. As part of being a public company, so we can own a slice of it, they have to release financial information to us, and they generally do that on a quarterly basis. So you usually hear a bit of buzz around, ooh, the earnings call is coming up. And that's when the CEO has to say, this is how we've gone, and this is how we, what we plan going forward. So I like research. I don't mind reading. There's also paid subscriptions I'm now kind of considering. So things like Morningstar and maybe the Motley Fool paid subscription, but definitely kind of a Morningstar type thing I might look at. And that's basically someone does the work for me, and they might come out with a rating of, this is a buy or this is a sell, which, might not be the time to buy it. But again, looking at the long-term view, if it's a company I back, I generally am I feel comfortable enough with kind of riding the waves with this one. So that's my approach. Nat, I want to hear your approach.
Well, mine, I think, kind of fights the kind of generally accepted research approach, bearing in mind that I have done this for a while. I don't believe in the myth I think it is a myth, of rational markets. And that's basically this idea that prices are baked in. There's all these people who are buying and selling in these big institutions, and enough people have done enough research that everything is basically priced correctly at the time. And that you can do this analysis and see sort of annual reports and know what's going to happen. For some reason, I've never bought into that. So I just scrap all that, and I have always been I love businesses, and that sounds super boring. I find businesses so interesting because they are stories about humans. So I do a lot of listening to things like Business Wars and How I Built This, 2 podcasts that I love, that basically talk about the humans and the strategies and the wars behind these businesses that have been created, and these trends, and so I find that stuff fascinating. So that's where I generally start, is by just really kind of getting to know the why behind a business. I was just finished listening to the Business Wars about Starbucks.
You cut out.
Oh, have I?
You cut out, so I'm just going to repeat it. Business Wars. It's a podcast that Nat listens to. You're good now.
Okay, so I've just listened to Starbucks versus Dunkin', and one of the coolest things in there was the CEO of Starbucks a while ago said, I want to challenge culture. And I think it was Starbucks or Dunkin'. I'm terrible. I should remember one of them. But I want to challenge culture. I want to be a CEO where my senior leadership team challenges me, and that we're making these decisions and we're constantly looking to go, how do we do better? I think that's a genius plan. So like, I don't care about their quarterly reports or how they're doing now. I look at kind of like much more that side of like, and that's why, even though I'm sorry to that I know Tesla can be seen as gambling, I've watched a few videos of Elon Musk doing like a 2-hour presentation of their strategy and his vision, and I believe in that vision deeply. And I think, I don't care if he doesn't get 100 cars built when he was meant to get 100 cars built. I don't care that he hasn't met his quarterly targets or whatever. I see this other part and I just find it fascinating, and I just get so into the company and I back it and I want to be part of it and I want to own it. So that's sort of the first part. The second part of and bearing in mind, I do try and put at least 60% of my money in very boring set and forget S&P 500, Berkshire Hathaway. I'm not a crazy trader. The other side, so once I fall in love with a company, and you actually can, and I know on the surface it sounds like numbers and boring stuff, I recommend listening to those podcasts or talking to people or reading up on founder stories and CEOs. It's just so fascinating. The second side of it is, I just think people are stupid, and I don't think the markets have prices built in, and I think we panic, and I think we're irrational. So for example, I was an early investor in Xero. I invested when they IPO'd, and if you go back and look back through every news article about Xero for the 7 years after, doom and gloom, this company was going down, they were never going to make it. No one understands, we talk about the concept of compounding returns, no one understood the concept of compounding growth, the idea of if you just get your first 100 and then you get your 1,000 customers and then next minute it's 10,000 customers, very similar to Hatch, by the way, with our 60-odd thousand customers now. Ask us a year ago, we were stoked to have 10,000. That thing of that people don't see that, and the market doesn't always price it in. And I find, and we've had actually a few Hatch customers tell us, sometimes there will be a bad article about Apple. They'll have done something stupid and people overreact and the share price plummets, and you just look and go, nothing has changed in that company. I think they're going to get through this, and you back it and you invest in it. So that's my approach, which is counter to basically every financial.
To be fair, it's not really that. I think we back those people that are changing the world, and that investing is about the future, and it's about growing these incredible new businesses. So it's probably just I attack it at a slightly different way, but totally agree with you.
Yeah, and I do some of what you do too. I think we both actually are quite similar.
Yeah. And if you look at Hatch investors, they're backing, they're backing technology, they're backing healthcare. People are always getting sick, particularly in this post-COVID era. They're backing, energy and even new forms of energy, but even existing energy kind of companies that are kind of reinventing themselves because they have to, of course. And then the final thing is space and exploration. They're backing that too, and that's that really future stuff, pretty crazy. So I know that Nat, I'm sure you'll be watching for Elon when whatchamacallit goes public. Who knows when? I haven't heard anything yet, but I've lost it.
I think we should take a quick break to talk tax for 2 minutes, for 2 minutes.
No, you actually have 30 seconds because we have one last section. Go.
Okay, so what was the tax question? Oh my goodness.
So we were tax. So under 50K, easy, guys. We basically give you the dividends, and all you have to do is pay tax on dividend. Your US stuff sorted for you. You pay tax on your dividends, just like any income that you would get. With New Zealand, if it's under $200, you don't have to worry about it. So under 50K overseas, you're basically just putting the number that we give you at the end of the year in your IR3 form as other income sorted. Over 50K net.
So yeah, I just wanted to clarify that $200. If you, outside of PAYE, all the tax you already pay, have earned less than $200 in other income, which would include dividends in the year, not interest, because that's already taxed, the IRD is not interested in you filling out a tax return. So do not worry. With interest, it's on there. It's on the IRD's website. That's not coming from me. Over 50,000. Again, people make it sound complicated. It's really not. You invest 50,000, 49,999. It goes up in value with 300,000. Fine, you're still under that limit. If you go over it, there's a bunch of options. We connect in with ShareSite that basically runs these two calculations. You pay a fee. You can sign up for a month if you want to. They claim
over 50K is a little bit. Is it kind of? It's a little bit more like capital gains. The over 50K.
It's basically just to keep in mind the tax that you would have paid on income here. So one of the easiest calculation, there's two of them, and most investors through Hatch who have over 50,000 invested overseas have decided, A, you're only paying tax when you make a profit or your money has gone up in value, which is a good thing. But B, because there is two calculations you can use, it actually sort of ends up offsetting some of the benefits of investing in New Zealand. They kind of end up same. But the simplest calculation is you basically take the value of your shares on day one of the year and you calculate 5% of that value and you pay tax on that. So yes, you're paying. But
I think unless you're a trader, which is you're doing this as a living and trading, and have a look at the tax blog on that. It's really simple and straightforward. We're going to leave it there. We're going to move on
about capital gains.
We'll leave it in the blog. It's all right.
Yeah,
we're going to leave it.
We are happy to continue this conversation. I think, James, you're particularly interested. I'm happy to give you a call and just chat about it. The blog, it's fine. Yeah.
Yes. So we're going to just end on, I want to remind you of the community. Christine, would you mind just posting the invite? Again, the invite is to enter your email into the form, and you're going to get a Slack invitation to a private channel where we can carry on these conversations. It'll probably take us a couple days just to get all the emails together, but probably by the end of the week, you can expect an invite again into a really safe space. So please go ahead and do that. And then I just want to chat about timing of when I should invest, because a lot of people are pretty freaked with when. And I think, there's a classic saying, it's about time in the market, not timing the market. It's really hard to know. Do you know that when the market drops, it drops far less than when it actually rises? So if you get out because you're scared that the market's dropping or about to drop, you never know when the market's going to bounce back up again. Last week would have been a great example. The technology stocks kind of tanked by 9% one day, across the board, and then they've since rebounded. And so if you're kind of trying to time that, you might have locked in your losses if you'd sold too late, and then you might kind of time that rebound. You would have missed that. So timing the market is not a good thing. I think you need to be, and that will kind of end on the note of, you have to be comfortable with your investments going up and down. Over the long term, the ups outweigh the downs. And if you're trying to kind of come in and out of the market and play with it, very few investors do that well. In fact, it's less than 1%. It's probably not anyone on this call, including us, which is kind of just like, you've got to be comfortable with seeing the red some days, because again, the greens, which is the positive days, tend to outweigh it. They say that yesterday was the best day to start investing. Today is the second best day. So definitely start thinking about building that wealth today, because the longer it's in the market, the better off you are. As Nat has already talked about, the share market's on average 10%. Some years are really big. Last year was over 30%, a massive year. This year, even with the crash, the general S&P 500, which is kind of seen as the market, that is up 5%. Even with a massive 30% crash, it's up 5%. So now I'm going to let you kind of end on kind of the what ifs and getting started in that small step.
Cool. Okay. So Only note there is we do have a few 60-plus-year-olds, and I think that again, just switch it up a bit to like a few people sort of say their emergency fund becomes 3 years, 5 years, whatever you want to do to make sure that golden rule of you just don't need to get your money out in a hurry. That gives you the best chance to, well, it gives you a great chance of not panic buying and selling. The last thing, should I just talk a little bit about quick scenarios for the last minute? Because I just think it's
Yep.
So one thing that I think is a really useful mental exercise to go through, like Kristen says, the share markets go up and down, and they do it a lot, and they do it by a lot sometimes. And we're just not used to it. Like if you have had your money in a bank account your entire life, theoretically, if you've lived in a property or you own a property, your property is going up and down in value all the time based on who's wanting to buy and sell it. It's just invisible to us. So it's a very uncomfortable feeling for most of us to feel, to see your money that you're used to being stable going like this all the time. So I always think a really, really good thing to do in advance of that happening is just think, what would you do? So earlier this year, there was about a 30% drop. So that if you had $100, it would only be worth $70. That never happens to you in your bank account. What would you do in that scenario? You've done all the stuff we've talked about tonight. You've picked an investment. You've put $100 in it. Now that $100 is only worth 70. A lot of people talk quite flippantly like, I'd be fine. That feeling you feel when you wake up and everything's red and you don't know when it's going to stop going down and you're panicking is a terrifying feeling that every investor has gone through. Best way to deal with it is to plan in advance and go, when that happens, I'm going to not sign into my Hatch account. I'm going to talk to my friends. I'm going to go on the Slack channel. I'm going to do all these things to just get over that mental hump. And I say that $1,000 or that $100 because all it goes from there is scaling up. Next time it happens, you might have $10,000 and it will only be worth $7,000. Ideally, in 10, 15 years, you'll have $100,000 because of the magic of compounding. But it's just the same number and you're so much more used to those fluctuations. So always, always, always plan in advance and really think through, what if my money was this and it's gone down to this? How am I going to deal with it? The other thing that I would highly recommend, and we talk a little bit about planning, is investing, like Kristen says, long-term gain. Doesn't matter what you plan for today, things change. You might have a baby, you might want to buy a house, all sorts of things happen in your life, and suddenly that magic 5 to 10 year time frame disappears, and you suddenly go, actually, this $10,000 nest egg I've been building that I don't think I need to touch, I'd actually quite like to use it for a house deposit. That is the time to plan for what you're going to change to make sure that you're not in a position that that money you're setting aside is doing this. And then the last point I want to make is if your investment skyrockets, which is a very interesting and under talked about thing. I am a Tesla investor. Kristen hates me talking about it, but my Tesla shares have gone up well over 1,000%, 1,000 point something percent. I plan to invest in Tesla for 20 years. My 20-year goal was ticked off in 1 year. I have been, watching that share price every day every week going, should I sell now? If I don't sell now, what happens if it goes down again and I've lost this money? And I go back to my plan and go, you told yourself you're investing this for 20 years. Do not sell today because you're panicking about losing it. That wasn't your plan. And just having that sort of documented thing really does, in those times of panic that we all feel, and all these like different things that go on in your brain, it just gives you that solid thing to know what you're going to do to stop yourself doing anything stupid.
Thanks, Nat. All about mindful investing, everyone. So have a think about that and do something tomorrow. We're going to leave you here. Thanks so much for the hour. When I say do something, watch CNBC for an hour, go on to The Balance, check out some podcasts, maybe The Business Wars, start the Hatch Getting Started course if you haven't looked at that already. Google it or go onto our website. It's a fantastic 10-day investing course. Reach out to us if you have any questions, but just do something to start to build wealth to get to that kind of dream life in the future. So cheers, everyone. Have a great night, and we'll see you soon.